we decided that we need to retouch on this topic and make sure everybody has the tools and knowledge ready. So first, we're gonna start with the business, with a roadmap. This is an excellent tool that you should have it in your desktop or download it in your phone as well. It will include all the different subjects, business subjects around around any small business. You can find resources about certifications, funding, business licensing, and of course, you're gonna find us as well as one of your resources for training. And please do so, download it, and you can really have a nice tool just a click away. So let me see how is this working out. We're gonna just take a quick roadmap poll just to see if everybody's awake. Okay, so did you know about the roadmap? Just give us a yes or no, or now I know. And which is basically the same as no. But thank you for your answers. Let me move my poll over here. Okie dokie, thank you. So there were some half and half split. Good. So you can have this handy tool right now. Good. Still voting. 8 out of. Okay, one more. And we are good to go. Thank you for your participation. Now I see that you are alive and you are not like a robot or something coming up into our polls. Share results. This is the results real quick. Mike, can you see the results as well?
A big portion didn't know.
Yes. So that we are very glad that you're here and we are here, so you can find out more about that that tool. Okie dokie. So let me close this. Stop sharing results. And we are out of there. So okie dokie. So let's continue with the presentation. So the content for today, we're gonna talk about organization and bookkeeping. We're gonna talk about general compliance, about record keeping, and things that the IRS has mentioned. How to classify and organize business transactions. This is the main dish of the presentation. We're gonna do a quick example about business transactions, okay? We're gonna use the Juan's landscaping example. And at the end of the presentation, we're gonna cover something about bookkeeping software benefits and some of its limitations. Some tips on what you should be looking for when selecting a software. Okie dokie. One thing, I don't know if too many of you know, but there's an IRS channel for YouTube. And I was, Mike, you didn't know? Okay. So I was checking that out. And IRS has also a lot of resources, publications. Of course, the publications now are updated for 2019 and for the 20 records. But these are the general publication numbers. It will touch on every single subject and it will give you examples and things like that. But we're going to provide you a little bit of a summary here so you don't have to go through all the publications. There's a small tax guide for small businesses. It's also a publication that will provide some resources, some tips about running a small business from the IRS perspective.
That's a great guide, Juan. I'll say the tax guide for small business, everybody should get a copy of that or download that. You can get it as PDF form on their site.
You can definitely see the perspective of the IRS on that way. But last night I was checking it out, and there are 51.1 thousand subscribers in the YouTube channel. Not bad for for IRS. Okay, I have less subscribers than that, so it's not bad. I think the last presentation they want from like 1,000 or 2,000 subscribers more from the last presentation that we did about this topic. I was updating some of the things, and sometimes they in the videos in the YouTube channel it is easier to watch or learn about IRS compliance. You know, if somebody's talking and being a little bit more interactive than just the general publication, IRS publication in black and white. So check it out. I mean, you can subscribe and then you can just receive general updates about small business topics and things like that. Okie dokie. So documentation and compliance. Basically, those publications on the IRS says you must adopt and maintain a documentation process for all business transactions. Okay, that's the general blanket compliance. And very important, adopt and maintain. So figure out what you want, figure out your way of doing things, make it a procedure, and maintain that procedure on an ongoing basis. The process must be kept up to date and separate for each business. If you are running two businesses, which a lot of people are doing right now, you know, you might have one business, but then you figured out that other business might be a little bit more profitable. Keep the separate transactions organized and updated. The process must show the business expenses and income organized. So whatever system you decide, like a box or a spreadsheet, a ledger, or I know some clients that still writing their transactions on the green ledgers that are separated for accounting purposes, like a T account for accounting. They're still using that. Yes, those forms are still available in your in your office supplies. Those green papers, it works perfect for them. They can really organize income and expenses, and it works. It is compliant. An adequate system or process. If you don't have an adequate system, it can result in penalties. Okay, so try to figure out what fits with you, with your personality, with your skills, and you have to establish it and maintain it. Supporting documents must be saved in physical or electronic format. Nowadays, it's much easier to save stuff. I mean, the receipts fade away. Everybody knows that. I mean, you buy something and then you want to return it. It's like, where's the information? I don't even know how much I pay for this. And you need to return some items. So after a year, 2 years, they will fade away. So if you have the option that the vendor works in an electronic format, they can save the receipts or you can collect receipts electronically, please use it. It's going to be much, much easier. If you have a scanner at home, it's a great investment. Have a scanner. If you have kids at home, it's a great activity for the kids. Scan receipts and let them show them how to organize and things like that. You can even pay your kids, but that's a different class. So supporting documents must be saved. It can be electronically, preferably. I suggest move to electronic format. Generally must be kept for about 3 years, but depends on the deductions. Why? Because there are some businesses that buy big items, for example, and they are gonna depreciate them for the next 5 years. Okay, so you need more than 3 years for that kind of documentation. So it really depends on what kind of transactions they belong to, but 3 years is the usual time frame that the IRS works with. Okay, so far any questions? We're good. So why get organized? I mean, I just mentioned some penalties and some compliance requirements from IRS, but organization lets you be more productive so you can take informed decisions. It's amazing how business owners are very, not business owners, and let me rephrase that. The business owners on the personal life, they tell their family members, kids, and things like that, hey, let's be organized. So we have to adopt the same concepts in the business. A lot of what's going on in your personal life is going to be reflected on your business. Okay, so try to find the motivation, internal motivation to be organized. Otherwise, it's going to
Now,
be more difficult for you.
that looks like my closet.
Okay.
The one on the left.
We lost you right there. So,
Oops.
I mean, it's much easier to get dressed if things are organized.
Of
I mean,
course.
I found that way. Okay. And in our house and many things in our life, we got used to it. Use, I want to call it departmentalization. You know, everything belongs to a box. And that makes more sense. That usually makes more sense in our minds, in our daily lives. I mean, why not have the fridge in the bedroom? You know, hey, it doesn't belong there. it's there are reasons for that. If you have a fridge in your bedroom, okay, that might be an exemption. Okay,
It's
but
just a mini bar, Juan.
that's a
It's just
mini
a
bar.
mini bar.
Okay, that's not where you keep the meat and the hamburgers and the
No.
vegetables. Okay? Mini bars, yes, they might be acceptable in the bedroom. But, you know, our house is divided and certain things belong in those divisions because they are more functional, they make more sense. Okay, so really, we can make decisions quicker and with more confidence. Okay, so if you're gonna start the bookkeeping process, find your internal motivation, find the end result as your motivator, that you're gonna be more organized, things are gonna be quicker, because getting to the habit and the learning about the bookkeeping, it might be a little frustrating sometimes, but the end result will provide you with the benefits. Okay, so bookkeeping, this is kind of the general definition. We want to give you the general definition and then more of our opinion. Bookkeeping includes the recording, storing, retrieving of financial transactions for your business. Transactions include basically everything, all inflows, all outflows, okay, by a business, by a person that has a business or an entity. The process has the goal to assign all transactions to the chart of accounts and save supporting documentations and keep it updated. Okay, assign all transactions to the chart of accounts. The chart of accounts, think about it, is like your different divisions on the house: kitchen, bedroom, bathroom, living room, patio, garage. A lot of things go in the garage. That's kind of miscellaneous expenses, I think. But the divisions are supposed to have that function where all transactions belong somewhere. Okay. How is it related to accounting? Okay. Accounting is the process of summarizing, interpreting, communicating financial transactions, which were classified in the bookkeeping process. Okay, usually financial statements are prepared during the accounting process. My voice is going away too early. So usually what happens is during the bookkeeping, it is more of a process of assigning things into the different divisions, into the different categories, into the chart of accounts. And then accounting, it's kind of a step further. You start organizing, analyzing, not organizing, mostly analyzing and retrieving financial reports, creating ratios and statistics and things like that, that it can help you make a more educated decisions. Okay, so bookkeeping is a process. The oops, did my presentation just close? Hello?
Yes, presentation closed.
Yes,
Okay.
presentation closed.
Well, and presentations are a process too.
Yes, I thought I got kicked out of my own class. So,
You know, maybe IRS heard we were having this little meeting, and
that's where I ran updates.
They didn't want the good info getting out, so everybody files properly. I don't know.
You got, you can see the presentation, right?
Yes.
Yes.
Okay. So, oh, that's weird. Sorry, guys.
It went away again.
I don't know. My PowerPoint is just closing. Let me do something real quick, guys.
Yeah, it's interesting here in Las Vegas. We had a somebody that was worked for IRS and was literally a taxpayer liaison. Okay, and their whole job was to work with small business owners to answer any questions they had about doing their taxes or anything you didn't want to really call the IRS for her. And it was really kind of funny because every time we do a trade show or something, she'd have a booth there and you'd watch people walk down the aisle and they'd literally see IRS as they're walking by her and they'd walk around the booth. It was a terrible thing. She said, I feel awful because people don't want to talk to me at all. But actually IRS really want you to file properly. They want you to properly report, and it's in everybody's best interest to accurately report your revenues and your expenses.
Mike, I'm gonna open it at the beginning, but I just sent you the presentation through email.
Okay.
So if that happens, can you just open it up on your end? And we share it. Okay. So if this happens again, we are prepared to continue with the presentation. So maybe it's just this slide that is. Okay, so chart of accounts, the bookkeeping process has the goal to assign all transactions in the chart of accounts. The bookkeeping process, it's the main process where we need to put everything on its place. Chart of accounts is a list of all your business account categories, okay, that are used based on your business transactions. So categories for businesses might differ from other businesses. If you have categories for the product, you might have different categories for a business that provides services. Okay, so think about the categories are advertising, marketing, professional services, you got supplies, you got your rent, all those type of expenses. So in general, they call it account categories, okay? So each account category only belongs to one of the 5 account types. Okay, so just follow me on this. We got categories and we got account types. We got account categories and account types. The account categories are based on how you spend your money in your business, but there are only 5 types of account types. Okay, and we're gonna find that. No transactions are left outside. Nobody is left behind. All the money, all the transaction has to belong to a particular category, okay? And therefore to a particular account type. So avoid that miscellaneous expenses or other business expenses account categories, but because that doesn't make sense. Think about it, Mike. Help me out here. If you are my employer, okay, and we have a reimbursement plan, okay, where you pay Juan, go and do some sales, whatever expenses related to that you have, bring me the receipts, and I will reimburse you. Perfect. Sounds like a deal.
Like a plan.
Oh, plan. Okay. So I come back and say, hey, this is for advertisement. This is for, I bought some office supplies in Office Max, and other categories, $500. Please give me my reimbursement for, $1,000, including these other categories for $500. Are you gonna just reimburse me that?
No, we want to see receipts.
Yes, and you will want to see what is these other categories. I mean, what are you talking about? You spend $500 in other categories? Elaborate a little bit more. I trust you, you're my friend, but this is a business. We're running a business here. There are no other categories for reimbursements. So everything has to belong to necessary and ordinary expense, like IRS says, related to the business. Oh yes, other categories was something that I bought in, Walmart, like an office chair or something. So,
and necessary expense, I think a lot of people understand it's a necessary expense of the business, right? Ordinary, though, can vary per type of business. Okay?
Yes.
So if I'm making a movie, let's just say, I may be making some crazy purchases. There may be wardrobe one day. I may buy a hang glider one day for a scene or something, but all that stuff
go into the TV categories, okay? Please.
All that stuff becomes assets of the business, right?
Yeah.
It's stuff that you don't, because I used to own an advertising agency, and when we'd shoot commercials and things like that, we oftentimes had to get wardrobe for the models. And they were like, I could just wear this home, right? No, you can't. That's an asset of the business. Take that off. You have to sell it or dispose of it properly. And as long as you know the rules, that's a good thing.
Yeah.
So just
ordinary
make sure
is basically something that is common for the business.
Yep.
Common
practice in your business.
If you're a butcher, you cannot deduct like a leather jacket because you're a butcher. No,
yeah, you need a Lexus. You need a Lexus, a really expensive Lexus, because it hauls the meats nicer, right?
Yes. Okay. So all the inflow and outflow for the business, it goes in a account category and then flows to a type of account. That's kind of the general process, okay, of the final end. This is why we do things in the bookkeeping: transactions, account category, account type of account. Okay, so your inflows, money in, money out, however you spend it, cash, credit card, checks, debit, recurring payments. Account categories, which are defined on your chart of accounts. That's like your menu. That's how you spend money and how you make money. And type of account it can only be an asset, a liability, equity, revenue, or expenses. Okay, those are the 5.
Wait, Juan, there's only 5? Only
It's only
5?
5.
I wish somebody would explain this earlier. There's only 5 types of accounts? Okay.
Yes, so every account, every category will belong to one of those types.
Nice.
So we're gonna build on those types. So this is one chart. Okay, I'm not sure. So 5 type of accounts. Assets. What kind of accounts or categories go there? Your checking, your receivables, your equipment, your patents, your software, assets, basically. Okay. Liabilities, short and long-term obligations, loans, taxes, accounts payable. I know that these are not the usual account categories, but we're going to build on that. Hold on.
Juan,
Equity.
can you
Yes.
define short versus long-term obligations for everybody?
Usually 1 year term.
So short term is a year or less. If it's going to happen in a year or less, long term is longer than a year.
Yes.
For accounting purposes.
Exactly.
Okay.
Liabilities, taxes, accounts payable, your general utilities or the sales taxes or payroll taxes, things like that. Equity is the capital contributions or retained earnings. So whatever money that you put into the business, it is called a contribution, which belongs to the equity. If you make money, it belongs to the income, revenue category, and income account type. Okay, income is sales or product of services, what you do for your business to make money. And expenses, we're more familiar with this, the ordinary and necessary business expenses. So in the practical world, we are very familiar with the categories for income types and expenses, but we don't forget about the other type of accounts: assets, liabilities, and equity, because everything will flow eventually to the assets, liabilities, and equity type of accounts. For example, we have the equity account, we have retained earnings. What are retained earnings? Is your profit, basically, right? So it's the earnings that I retain, basically the earnings that were left over for my business. So I will call them a profit. I made money. I retained that money. So, but that's the result of what? Your income minus your expenses. Okay. So that's how you get your retained earnings in the equity. This is kind of another way. I know a lot of people are visual. So this is the same 5 type of accounts: assets, liabilities, and equity. I'm pointing with my finger. You cannot see me. Okay. Income and expenses. So assets are bank accounts, accounts receivable, prepaid expenses, inventory, fixed assets. Liabilities, accounts payable, sorry for the mistake, credit cards, loan from banks and others, sales tax payable, retained tax, for example. Equity, shareholders contributions, members capital, if you have an LLC, it will just change the name, and retained earnings. The bookkeeping process has the goal of organizing, but why are we organizing all this information? The end result, like I see it, the end result is to properly come up with a balance sheet report and an income statement, because those are the financial statements that really tell your story, your position about your company. Those are the financials that are being required now that you are requesting loans, you are requesting assistance, and anything else. So the bookkeeping process, it is a process with the end that will organize all those transactions. But I think that our goal is to come up with a good balance sheet and a good income statement.
Juan,
okay. Yes.
If I could put this in here, I think most small business owners who have a basic or even an intermediate knowledge of accounting sometimes do not understand what the balance sheet actually does. Right? That's a thing that that we used to come across all the time. I think most small business owners really understand the income statement, right? I have revenue that comes in every month. I have sales that come in, and I have some expenses, whether they're variable and fixed. And you can
That's a
kind
great
of
point.
tell how you're doing in the short term. However, without looking at the balance sheet, you really can't tell the overall health of the business. So if I'm trying to sell my company to you, you want to do your due diligence and make sure it's looking good. You want to look at my income statements, and let's say my revenue is really good and my profitability is really good. That's talking about this year, right? What have I been doing the last 5 years? How much did I have to invest in this company to make that income realistic right now? Right. And so what type of liabilities do I have? What kind of loans do I have? Did grandma loan me $10,000 to start the business? Is that on the books? Like, where is this?
Mike, but from now on, the balance sheet, I think it's going to be more relevant because there are too many loans outstanding out there. I mean,
absolutely.
The profit and loss is going to tell you, okay, by January of next year, you know what, things are getting better. I'm starting making money. But that doesn't tell the whole story, like you said, because if you look at the balance sheet, I have an SBA loan for $250,000 for the next 30 years. You cannot find that information in the income statement.
No.
So definitely you want the liabilities.
The other thing too is you can't tell how old those assets are that are making you money. If you have a let's say some sort of production equipment, how old is that production equipment? How much is it worth? Stuff depreciates every year, right? So how old are those assets? Are you going to have to replace those soon? That's some stuff you really have to think about when you're acquiring a business, or when you're looking at the overall health of a business. How much money do they owe to not only to credit cards, but to bank loans, tax liens at this point? There can be a lot of different stuff. And then how much do they owe equity-wise to shareholders? Maybe there's been contributions that have been put into the business. Maybe the owner has had to sink $100,000 a year into this business the last 5 years, and you're just looking at the income statement. That you have to look at the overall picture. That's why the balance sheet and income statement are so important together, is because income statement shows you how you're doing right now in overall sales and expenses. The balance sheet shows what it took to get there right now. Okay. So I just wanted to put that out
and
there.
The balance sheet is just a specific point in time. Like we see here in the slide, it's like a picture, boom, what's going on. And the income statement, it can be spread throughout a period of time.
Yeah. Thank you, Juan. I love this slide, though. I think this really perfectly shows everything all in one little view. So
this is the goal: have a nice balance sheet that others can use it, and specifically the business owner can use it. Okay, and remember that we started with, let's find internal motivation to do all these things. This is something that you should know. You know, it's like a picture. This is how wonderful. Imagine that it's like taking a picture of I don't know, your children. This is the picture. Your balance sheet is your picture of your business.
Mm-hmm.
It looks so great or it looks so bad. So it can help you fix it up.
And keep in mind too, just bookkeeping in general is just what happened, right? This is a story that's already written. You just are putting it onto paper.
Yes.
This isn't creativity time, right? This is not a fictional work.
Process.
This is a real thing that happened.
Yeah.
You need to put that down. Sometimes entrepreneurs are, writing the story, and it's like, no, you don't write your story in your accounting. It's whatever happened, and it needs to happen in the period it happened in, right? So if you had transactions in December, don't put them into January. They happen in December. Put them into December. Embrace the horror for what it is at the moment.
I'm not gonna deduct it next year.
Exactly.
So try to have that end in mind. And all transactions are gonna be assigned to a category which will belong to a type of account eventually, okay? Which everything will flow nicely to a balance sheet and income statement. Yes, there's a cash flow report, but the cash flow report, it can be really easy generated if you have these two reports and everything organized already. So let's see if my poll still works here. Let me just double check. Renowned. There we go. So can you see the poll?
Yes.
Perfect. So let's see if we lost some people or not. So let's see. Oh,
Who is IRS?
we have to put some,
Anybody puts who is IRS, you get a free donut today. Did your PowerPoint quit again?
No.
Oh, okay.
We're good. I'm trying to find my poll.
Every transaction, the business must have a category if it's non-business related. Okay.
There he is. Nice. We got some people thinking about it. And it's something that just to review a little bit, the bookkeeping, it has to be for the use of the business owners. Okay. We're gonna leave it a few more seconds. So nobody.
It's a tough question, number one, Juan.
Yeah.
Except for option 3, I would say.
We need to double check,
Raina, what would you vote on number 1?
Who's IRS? I'm just kidding.
I'm a little unsure. I'm like, can the IRS assess penalty? I know they can assess penalties for whatever they want, pretty much.
Is it a person? Is it
not bookkeeping?
No.
They try one time to assess a penalty for a payment they already did. Like, really?
We have taxpayers' rights.
They told me they were going to forgive interest and penalties in a year that I had no tax liability. I thought that was nice of them. I said, thank you. I don't have a tax liability. Oh, well, we meant the other year, You have to check their work sometimes.
Just take it. No, definitely. We need to double check the work of the IRS always. They can make mistakes. They're humans behind those computers. So definitely we have our taxpayers' rights.
So Juan, what's the answer to number 1?
Number 1, we do bookkeeping only because IRS might have assessed penalties. You know what? It should be false in reality, because the bookkeeping, it's something that we want to do because we want to have control on our business. We want to have, we want to know what's going on. And we have to move from that true to that false. And it's a process, okay? Yes, the penalties are there, and yes, you should be doing bookkeeping, but that shouldn't be the main driver behind the bookkeeping process. The bookkeeping process has the intention, has usefulness for the business owner, okay?
Wait, so can they assess a
IRS,
penalty? Can they assess a penalty for not
yeah,
bookkeeping?
there are penalties for not being organized, and you start deducting things that are, you don't even know
So
where they come from.
one is true.
The tricky
Oh, you
question
said
is we
only,
do
never. You
bookkeeping
said
only
only. Oh,
because IRS might assess penalties. No, we do it also because it's good for the business. It's
Juan
good
used to
to
write
have
questions for
control.
the SAT test.
So every transaction in business must have a category, even if it's non-business related. True. Okay. What are those categories that are not business related? They might be considered as owner withdrawal, owner payments, even though they might not be related to the business, they will belong to a category, okay? And if it's, the money was taken by somebody that didn't have access, shouldn't have access to money, yeah, it's a category of theft. Or if the business owner just took money out of it without proving that it's a business transaction, without documentation, yes, it's going to be a distribution, maybe dividends to the owner. Okay, so a business that provides services will have the same account categories that a business that sells products because they're both for profit. No, okay, this is false, because every single category, for example, sales taxes. Sales taxes only will show up in somebody that is that sells products, not somebody that provides services. Okay, so that's the kind of the interesting part about bookkeeping. Depending on what your business does, your industry, your line of business, it will have its own categories. Okay, not type of accounts. Type of accounts, yes, it will be across all businesses. Okay, even nonprofits. So that's if you have any more questions, let me know. I'm gonna end the polling right here. And did you guys see the results? No.
Mhm.
Yeah.
Okay.
Yeah.
Okay. So we're gonna just stop sharing the results and move on with the presentation. So just as a review, all transactions are gonna move to categories, which are the chart of accounts. This is your menu. That's how you spend money and make money. All these categories are gonna belong to a type of account: asset, liabilities, equity, income, and expenses. And with this type of accounts, we are gonna produce these nice reports: balance sheet and profit and loss. Okay. And these financial reports, we can do ratios, we can do a lot of stuff, cash flow statements, and things like that. Okay. So keep this in mind, and let's move on to the exercises and examples. Hopefully, okay. This is kind of the same thing. Okay, let's organize each category with its type of account. These are not transactions. These are categories, okay? if you go and buy stuff on the, I don't know, Office Max, you bought a sign. That's a transaction that belongs to the category of advertisement, okay? But let's find out what type of account it is. Advertisement is an expense, okay? So supplies, let's see how fast people can type in the chat. Find your chat window and you can
I found my chat window, Juan.
start
And if
typing
anybody
here.
has any questions, you can put them in the chat window, by the way.
Yes, definitely.
Q&A window.
Yeah, I put a message early.
Okay, so Mike, Reina, start. Yeah, you have to participate as well. So supplies.
Okay. Supplies, expense.
You say type.
Oh, I'm sorry. I type.
Okay. Small tools. Okay, hold on. We have auto loan versus auto lease. Yes, they are different. The lease, you don't own the asset. Okay, let's talk about just, it's Friday morning. Let's talk about the general lease, okay? General lease, not the ones that you have the option to buy and blah, blah, blah. That
Like I'm leasing let's say I'm leasing a piece of equipment, right? And I have $1 buyout at the end of this 5-year lease.
Exactly. So the lease, it will go into the expense category. The auto loan, you own the vehicle. So the vehicle will go into the assets and the loan will be under liabilities. Okay. Yes, that particular scenario, lease and auto loan, it will use different account categories and account types, which is very important when you do your taxes and come up with the balance sheet. Okay. Yeah, don't put your auto lease in like assets. Oh, this is the car that I have. You don't have the car. You don't own the car. Okay. Yeah. So small tools, expenses, I heard.
Yes.
Cash.
Asset.
Even though it is under the couch and it belongs to the business, yes. Rent.
Let's hope it's in the bank, Juan. I'll just throw that out there.
Expense. Auto loan. Oh.
That's.
I gave up the answer already, guys.
That's expense?
It's a loan.
It's a liability.
Oh.
Yes. Checking account.
I know my liabilities, Juan. I'll say that.
Checking account. That's
asset.
There we go.
Mike, you're good.
Of services.
Sale of services. Asset?
Asset. It's a revenue account, right?
It's a revenue. Income. We got only 5 category account types.
Oh, yeah.
Sorry. Okay. Employee salary. Expense. This is a tricky one. Collected sales tax.
Liability.
Yes.
I told you I know my liabilities.
So this is a quick example, okay? If you something is $100, and let's say that our sales tax is 10%. We might get there eventually. So 10%. So Mike, I go and buy this from you. You know what? I'm gonna have to give you how much? 100 or 110? I have to give you $110.
110, and then
100 plus the 10 of sales tax.
Yeah.
So you, in your bookkeeping, gotta be very careful because your revenue is how much?
is 100.
It's only 100. The
Yeah.
other $10 belongs to whom?
To the government. Taxes, everything
To
is done to the
to the
state.
state in this case. So your, even though it came in your bank account, it shows $110 as a deposit. In your bookkeeping process, you're going to separate, okay, my assets increased by 110 because my checking account is 110 more bucks.
We had this conversation yesterday with.
But hold on. And then you have to put $10 that you owed to the state because that money doesn't belong to you, and you only have to consider $10 as your revenue. Okay, so you did not make 110 bucks. You only make $100. Okay, yeah. Don't consider revenue as some money that doesn't belong to you. I mean, it's all about not reducing your tax liability, right? I mean, why are you going to pay taxes on 110? So some people do the bookkeeping process a little bit differently. They might record it 110, then they take the sales tax as an expense. But that beats the purpose of the whole bookkeeping process, because you have to know that $100, it's an accounts payable that you have on your shoulders, that you should not be touching that money because you have to send it, next month to the state. Okay, so that's one of an example of the proper use of the bookkeeping and why we don't do it only because IRS says so. Owner's contribution. What type of account?
Equity.
Yes. Payroll taxes collected. Just to be more specific, if you're an employee, good, you make $100, but I have to withhold taxes from you. So your net check is only $90. $10, IRS says that I have to take it from you. So what happens with those $10? What are those? Payroll taxes collected.
Liabilities.
Those are liabilities.
Yep.
Okay. So
I'm kind of seeing a trend with taxes here, Juan. Taxes seem like they're liabilities.
yes. line of credit with the bank.
Sorry, it's Friday.
It's a liability as well. Gas payment.
Expense.
Nice.
Finally, I got one.
Good job, Reina.
I'm good with expenses.
Good expenses.
Sales of products.
Income.
Income.
Yeah.
You got two.
Owners draw.
Equity.
There we go. Okay.
I was just going to say in business school, they described assets to us as assets are things that you own that are of value, right? That have some value to it, right? Liabilities are legal claims on your assets. So
yes.
if you look at it like that, everything that you own in the business that has value, whether it's cash, receivables, stocks, patents, whatever. Liabilities are legal obligations you have to pay people, right? That are all legally documented, that are claims on those assets. Once you satisfy the legal aspect of it, you remove liabilities from it. So if you take the liabilities out of your assets, whatever's left over is your owner's equity. So that is that's your kind of profitability, your net worth in the business. There was a question, Juan.
Yeah, I saw that.
Okay.
So owner's draw and contributions are the same. Owner's equity. So yes, one is owners. Let me see. Owners' contributions are money invested in the business. I'm gonna start the business. I'm gonna put $10,000 into the business. That is not revenue. That's owner's contribution. That's owner's equity. The business, I mean, I have $10,000, my own money in the business. That's my owner's equity. Then you got the draws. Basically, I tell the business, I need some of that money back to me. Or if I own my own business, I can basically take the money. That's gonna be an owner's draw. And this is very important in the cases that, for example, let's see that you have a simple business, simple structure, schedule. Let's say you have an LLC, one member, and the business is, let's use my example, the Juan's Landscaping. Okay, I went and made $10,000 in a business, in a sale. Okay, that's income, 10,000. Then I had expenses of about $5,000 in general expenses. I pay some people, I rented equipment. So what's my profit? My profit is 5,000.
Nasty
Okay.
blood, it's going to be good to eat.
Okay, my profit is 5,000. 10 minus 5, 5,000. But what about if I go ahead and said, I need money from the business, and I take a draw of 3,000. Okay, 3,000, I'm gonna take it from the bank and put it in my pocket, on my personal account. Okay, it's gonna be recorded as owner withdrawal, owner's equity. Some people think about that as an expense. Okay, and if you think about it, what's my profit after I took the owner's draw? I took 3,000, right? What's my profit after I took the owner's draw? It did not change. It's still 5,000. Okay, I still have in my bank account only 2,000 because I took 3 out of the 5 that was left over. But my profit and loss still shows a profit of $5,000 because the owner's draw are owner's equity account are not an expense. Okay, so these and that's how my profit and loss is calculated. Revenue minus expenses, profit, I pay taxes. Okay, so usually when the people start taking money out of their own businesses on those owner's draw, they think it is an expense. No, it is not an expense. It is an owner's equity. Therefore, in your profit and loss does not get affected by it. And you will owe the same amount of taxes, even though the money is not there in the bank anymore. Okay, so owner's contributions, in that example, let's say that I put $5,000 into so I can rent equipment because I didn't got paid. Owner's contribution 5,000. I made $10,000 in the business. I spend the other 5, and I need some of my money back. I take 3,000. My owner's equity is gonna go down by the 3,000 that I took. So good, you got it. Nice, thank you. So that's the whole process. I mean, of the bookkeeping. You figured out. A lot of people are saying, "Oh, I have to wait. I don't know how much." This is my favorite part. I don't know how much I'm gonna owe in taxes. You know, it is January 5th. And oh, tax season is coming. I don't know how much I'm gonna owe in taxes. You have the whole information in your books. You know how much money taxes you're gonna pay because you have a profit and loss and you have a balance sheet. Okay.
And you should know your tax rate from last year.
Yeah, you just have to go to the tax guy. So we'll punch in some formulas, some things like that. put it on the right forms. Maybe think about some tax savings strategies for next year, things like that. But all the information is there already. Okay, this is the dream of in our industry, that all the clients come up with a nice set of books with a balance sheet and a profit and loss. Okay, that's kind of we call it we have the New Year's resolution. In our industry, in the tax industry, we have the tax year resolution. You know, where in the tax time, everybody starts promising, I'm gonna keep my books order, I'm gonna have everything organized, I'm gonna save my receipts. I'm gonna, every single year, around April, March, we'll start hearing those tax year resolutions. It's kind of funny.
It's like going to the gym in January.
Yeah. Yeah.
You're
The same happens in
hitting
April.
the books in April.
In April, exactly. It's kind of a, you know, tax industry joke that we have. So this is just the same chart as a reminder before we start doing the example. So far, I don't think we have any questions. Okie dokie. Now, everything has a balance in numbers, in math. This is kind of keeping the force in balance, okay? This is assets will always or have to liabilities plus owner's equity, okay? This is kind of the magic rule. Assets equals a liability plus owner's equity, okay? These three will also rule all the income and expenses. I'm gonna show you how. So assets, we know, we talk about it. Checking accounts, inventory, accounts receivable, deposits, things like that. Liabilities, loans, taxes, accounts payable, okay? Plus owner's equity, which are obligations to the owner, basically, or owners, if you have partners, if you have stocks, plus capital contributions, plus earnings. What are the earnings? Are the income minus the expenses. So if you think about it, this equation, assets equals liability plus owner's equity, also includes the income and expenses. Why? Because it is like embedded in the owner's equity. And it kind of makes sense. If you have a building, you know, of, I don't know, $500,000 in the asset side, how did you get that building? Even though you owe money on it or you pay cash for it. And usually it's a mix. So if in the asset side, it says, okay, I have a building that I bought for 500,000 and it's in my books as an asset. We're not talking about market value, okay? That's a different class. So we're talking about the actual cost basis acquisition value, okay? 500. It has to come from somewhere. Or you took a loan or you put up the money. So kind of, you have to see that the equation makes sense, or you made some profit, right? Okay, can be an example of I borrow 300 from the bank. I put 100 from my own pocket, and last year I made money on my business, which helped me from the retained earnings, from the profits, retained earnings from a previous year, help by the business with that 100, with the extra 100. So that makes sense. That's how I bought, or how I have an asset of 500. Okay, and there are a lot of more details into this equation, but this is a class to help you understand the process that you can actually supervise, and then you decide to hire somebody, but you don't hire somebody with blinded. Okay, you know what's going on, you know how it works, but you don't do it. But you know how it works, so you can double check the results, the profit and loss, make sense of the balance sheets and things like that. Okay, so if your balance sheet is kind of wacko, you can actually tell, and you can maybe fire that bookkeeper or something. Okay, or you can ask them. If the bookkeeper is not giving you a monthly balance sheet and a profit and loss, it beats the whole purpose. I mean, that was the whole goal of the bookkeeping process. So request that on a monthly basis so you can know what's going on. Okay, let's start with an example because might be running out of time. Okay, July 2nd, Juan invested 50,000 to a new landscaping business. Okay, and we're gonna try to keep the equation on balance. Okay, so into the bank account it goes the 50,000. It's my money, I'm the owner, so it goes to the initial capital or owner's equity of 50,000. Do we have a balance? Yes, 50,000 on one end, 50,000 on the other end. Okay, this is how the accountants and bookkeepers they find things. I mean, if things are not in balance, or our categories are a little bit overstated or not, this kind of how they follow the money. 50. On July 5th, Juan bought equipment on credit. So if I buy equipment on credit, I owe the equipment, it is an asset, $10,000. But you know what? I didn't pay it out of my bank account. I went and I borrowed the money on credit. So I have a liability of 10,000. Again, liabilities plus owner's equity, 60,000. Assets, bank account 50, new equipment, 60,000. On July 7th, Juan bought on credit 10 pieces of artificial turf to have on inventory for future jobs. The total purchase was $1,000. It was about 100 each. Okay, so I will add up that to my asset side because it has some value. I pay for it. So it goes $1,000 in my inventory, but I took that on credit as well. I like credit. I like using other people's money to fund my business. So $1,000 on the liability side, we have the same 61. Okay, everything clear right here. We just use the balance sheet. Okay, now we use the balance sheet side, assets, liabilities, and equity. Now we're gonna mix it up with the income and expenses. Okay, all those transactions that we did were related to the balance sheet. I didn't make any money, okay? Or I didn't expense any money from my business account, okay? Everything was credit and everything was an asset, okay? Now we're gonna mix it up with the income and expenses. So On the right-hand side, we still have our balance sheet, and over here we have our income statement. Okay. I should be able to have like a pointer. Can you see that, Mike? My little globe?
Yeah, that's kind of cool, Juan.
I know, it's Friday. So, on July 9th, Juan made his first landscaping service. Finally, I'm making some money. The client paid $300 in cash, okay? Even though it's cash, I go and report it on my income and I put it on my bank account, my business bank account, even though it's cash, okay? So on the income side, income statement side, we're gonna have income of 300 and then my assets of 300 because I put it on my bank account. Okay, now it makes sense, 61,300, okay? But how I came up with this, with the 61,300 on this side, on the owner's equity side, is because we take into account what happens in the income statement. I made income, I made money, I didn't have any expenses, therefore I have a profit of 300. So that 300, what is it? It's retained earnings, or earnings, profit. So it goes into the owner's equity, 300. That will keep things on balance, okay? This particular transaction is very important and you understand because it will help you understand the relationship between the income statement and the balance sheet. How after you make money, that's retained earnings and will go into your retained earnings owner's equity side. Okay, that's how the balance is kept. Okay, now let's hopefully we don't have any questions, so good. 300 bank account, profit of 300, therefore it is retained earnings, therefore the balance is kept. Now on July 12th, the business spent $100 in gas for the truck from the business checking account. So what happens? 300 was my income originally. It's the same income, okay? Same income, nothing changed. It's not additional income, it's the same. Because income is a process, time period. $100, therefore my bank account goes down $100. And then sorry, I kept that in Spanish. My profit is $200. Therefore, my retained earnings goes down from the original 3 to 2, okay? Because I don't have that kind of profit anymore, okay? I didn't close the year or anything like that. It is an ongoing process. So once I updated my profit and loss with the new expense that I had, it is translated into less retained earnings, less profits. So it keeps the balance with my updated bank account. Okay, it is kind of the same thing as making money, but now we are spending money. So you can see the relationship between the income statement and the balance sheet. Okay, $100 out, less profit, less retained earnings. We move on. On July 15th, Juan installed one of the artificial turfs, and the client paid $500 for this service. So the inventory went down $100, but we made money, $500. Cool. We're making money. So $800 because we have the new profit, direct cost of $100. We have the sales expenses from before. We got our net income from $600. Our inventory goes down because we used one of the turfs. The 600 retained earnings flows over here. So we got this 61,600 on both sides. Okay, same thing. Profit and loss is just affecting the results of the profit and loss. It is affecting our assets and owner's equity the same way. There were 500 in expenses related to the office and administrative. So we have $500 administrative expenses, which come out of our assets, the bank account, which translate into net income of $100, which affects our retained earnings, and the balance is kept. Okay. So this is how everything flows through the bookkeeping process. As soon as you make one transaction, it will belong to a particular category. That category will fall into one of the 5 type of accounts, which will affect, it will change, it will update. I don't want to say affect. It will update your income statement or your balance sheet. Okay. Always just keeping that the balance. All transactions into categories. Categories belong to a type of account, which we can generate into financial reports. Okay, so this is the bookkeeping process. This is what's going on based on the rules of accounting, just to keep the assets equal to liabilities plus owner's equity. Now we have software. Now we have software, which is based on the rules that we discussed before. Okay, so there are a lot of softwares out there. We got Patriot, we got Zero, we got Soho, we got QuickBooks, of course. QuickBooks is losing market, really. I tell you that. There are Wave, Xerox, FreshBooks. FreshBooks is the same company, I think. But Patriot, those are companies that are stepping up and are having different interfaces where you can use their tools. So the whole process that we talk about, they help you out. Okay, software are tools that just follow certain rules. Now you have to make sure that you know what's going on with the software, just to double check if the tools are being properly used. Okay, so what's the whole purpose? All this software is classify transactions and memorize repetitive task activities with the options to make changes manually. Okay, this is what the software does. it will help you classify all these transactions into the proper categories, into the proper account types, but you have to double check, and it will help you produce all your financial reports. I don't believe that we should start with explaining the software. I believe that we should start explaining what happens behind the scenes of the software, of the bookkeeping process, why we do it, what's the purpose, what's the flow, okay? So you can better understand which software is more appealing to you, okay? Because a lot of, which is the right software for my business? It has to depend on your needs. The softwares can track inventories, can track accounts payable, can track invoices, can track a lot of things. But it really depends on what you need. I mean, there are some businesses that don't need something too complicated. Many software has a lot of whistles and bells that you will never use. Okay, like tracking inventory or tracking jobs, or like a tracking cost assessment. For example, a contractor that has different companies working, yes, it will probably need to, if I buy, $10,000 of materials, it will probably have to track to which job it goes to, so they can actually tell how much money they're making on that particular client. But somebody has a hair salon, where they charge rent to the other hairdressers, and they have some supplies, they have rents, and that's basically it. Okay. There are some businesses that they don't need to track sales taxes. There are some businesses that they don't have employees. So it really depends on your needs, and ask your business. This is a little bit funny, but hey, business of mine, hey, dear child, what do you need? What kind of software do you need to keep track of all the information? What do you expect from this tool? We have some basic expectations. I mean, the basic expectation is to have a organized balance sheet and profit and loss. But do you expect the software to pull all the information from your bank account? Do you expect the software to memorize transactions, to keep track of accounts receivable or not? There are some businesses that just collect money on the spot. They don't do credit, so you don't need accounts receivable for that. So it's really, it's like many things out there. We got a lot of customization going on. So you have to go inside your business first and decide what kind of information do you need. Now you know the basic process of bookkeeping. You know the basic requirements that you need. Okay, but you need to be able to change your chart of accounts, for example, because you have different categories for your type of business. So you definitely need to do that. How you can evaluate is it good, if it's a good tool? How much are you paying for it? How much time is it saving you? Are you able to print out an adequate balance sheet and profit and loss that you can compare from month to month? Okay, if you can do that, definitely you are using a good tool. What to expect from the bookkeeping software? This is some basic needs, that I think are important. Import transactions directly from your bank, so you are not typing. It's going to be less mistakes on the numbers. Memorize transactions and repetitive actions. Hey, software, every time you see Office Depot, it is office expenses. Every time you see this guy is rent. It's a fixed amount, so don't ask me about it. Memorize this transaction. And of course, create all 3 financial reports from the recorded transactions and you financial profit and loss, balance sheet, and cash flow. And be able to have comparisons like monthly, yearly, so it can definitely help you. Some categories are already created in the chart of accounts. These softwares come up with a little bit of an interview process and will assume certain categories. Okay, you have to review your chart of accounts, which is your menu. This is your rooms that you allocate transactions to. Delete the ones that you don't use. I mean, why use them? You might get confused. Just uncustomize them. You know, for example, expenses. I want to know how much I spend on certain items, and I can really differentiate that. You can be really, really specific with a software. I want to know how much I pay to all my independent contractors. You should have them separate, not all together bundle in professional services, because at the end of the year, you need to do 1099s. So you need to know how much you paid to every single person. Okay. That's one example. Main categories are already classified under a type of account. So the software will come up with advertisement. Yes, it will already be classified under expenses. Most of the softwares come up with owner's draw, owner's contribution, already attached to owner's equity type of account. But double check, because if the category is assigned to a wrong type of account, it will mess up everything on your balance sheet and your profit and loss. Okay, I see a lot of people just importing transactions on every single deposit. They put it under income, revenue. But sometimes no, sometimes they were short like a couple of bucks. They put $200 on their own personal money. That's not income, that's owner's contribution. Okay, so don't assume all deposits are just income. Assign the proper accounts, otherwise you're going to be paying more taxes or losing expenses. Flexible access, I mean, you can share that with your tax person. You maybe can have access online. If you don't like online, you can have it only on your desktop and create reports there. Maybe export to PDF, export the transactions to Excel, so you can manipulate the amounts. You can create graphs. That's all the general expectations. Now, in extension, we are all about taking action. Okay, education is great, but if all this conversation for about an hour and a half that we had just dies here with no action, it's going to be a waste of time. Okay, so the bookkeeping process, it is a process. Okay, therefore, what? You have to mark it on your calendar. It's not going to happen. It is not fun to do bookkeeping many times. Okay, so you have to put it in your calendar. That special day where you and your business are going to get inside the business and find out what's going on. A reality check moment between you and your business. Okay, how organized you are, how well are you doing things, how are you going into the wrong path. I mean, that has to be marked in your calendar weekly. Yes, weekly. It's like, you know, your weekly going to church, weekly gym, weekly walk, weekly bookkeeping. Okay, write down your process and steps. If you're beginning this process, it's gonna take you more time, but it will get easier. Just write down sometimes you go and research, oh, what type of account was this? Or how do I enter this and that? Write it down, because you might have the same question a week from now. So you don't look for that answer again. Write it down, write down the process. I do that. I mean, sometimes like taxes, how do I do this thing? I write it down. I have like a little cheat sheet for me, so I can remember all this stuff. I buy a yearly book. Every single year we buy a summary book for taxes and revisions and things like that. There's no way we can keep up with everything. So take notes, save them as reminders. Maybe the sheet that we share, transactions, categories, type of accounts, balance sheet, income statement, just as a reminder. Standardize your process, and it will become a habit. Okay, so first I open up QuickBooks and I do an update. Second, I categorize everything. Third, I pull up my monthly report. Fourth, I compare it to last month. At the end of the month, if it's the last week of the month, I'm gonna just double check it, reconcile with my bank account and my credit card to see if nothing was missed. Technology is great. You see that my PowerPoint just flicked on me and just closed. Technology is great, and so far as it works. Okay, so you need to double check. And learn from your bookkeeping. Learn how your business is doing, learn how you are running. I think the bookkeeping process should be like a scorecard, how the manager is doing. If you didn't make a profit, start doing some changes. Take action and try to enjoy the benefits. I know it's hard. It's like trying to enjoy tax season, but it's something that we have to do, and it's something that it must be done. It is subject to penalties. It is subject to compliance requirements. So get the process going, adapt it to your own needs, to your own way of doing things, and enjoy the benefits of being organized and having a nice profit and loss and a balance sheet that you can be proud of. Take that picture of the balance sheet that you're proud of. Review your chart of accounts, because every category has to be under the correct account. Do not mix personal and business expenses, because this is gonna make your bookkeeping more complicated. Okay. There are no such a things as credit card expense. Okay, credit card expense does not exist. Why? Credit card is a liability. Okay, the money that you spend inside that credit card or using that credit card, that's an expense. That's the one you have to classify. So if you pay your credit card and you said, oh, Joe, that's a credit card expense, like, no, you pay your liability. Now you have to tell me what kind of liabilities you use or you spend your money on. Okay, the credit card was used for advertisement. It was used for travel expenses and things like that. Those are the expenses that you have to categorize, not the credit card payment. Okay, credit card payment is a payment of a liability, nothing else. Okay, those are not income and expenses categories. Do not mix independent contractors with employees. Do not put your independent contractors under the employee categories, okay? Because that will send the wrong signs to the IRS and to your tax person. Invoices or bills, you need to assign the corresponding payments and deposits. This is something to be careful of. If you create an invoice, the many softwares will keep that invoice open until you attach a particular payment to that invoice. I've seen that a lot of people have income statement, perfect. The balance sheet says accounts receivable $60,000. I tell them, I mean, how are you running your business? There's a lot of people owing you money. They're not getting paid. Oh, no, they already paid me. Those are just things that the software does. No, those are things that you allow the software to do. Don't blame it on the software. You are in control of the tools. It's like hitting somebody with a hammer. You know, oh, the hammer hit you. No, you hit somebody with a hammer. Okay? So the software does what you allow them to do. If you create invoices, you have to attach the payments to those invoices. Otherwise, it's going to create a mess. Reconcile every month. Do not rely blindly on technology. And of course, create your financial reports and profit and losses. I hope this information was helpful. We are building new classes. We are building, we are providing tools, we are providing knowledge to the business community to help them mitigate that risk of being a small business owner. Okay, I think that's up for me, guys.
Thank you, Mike. Thank you, Juan. Thank you, everybody, for being here today.
Thank you, guys.